Combining the VIX with technical indicators in trading can give you a more complete understanding of market behavior, especially during periods of uncertainty. The VIX, often called the Fear Index, measures expected volatility in the S&P 500 over the next 30 days and is widely used as a barometer of market sentiment. When VIX levels rise sharply, it signals heightened fear and uncertainty, which often leads to increased price swings across global markets. On the other hand, a falling VIX suggests that traders are expecting calmer conditions. However, relying on the VIX alone is not enough to make trading decisions because it doesn't show specific price levels or trends. This is where technical indicators come into play. By combining the VIX with tools like moving averages, RSI, Relative Strength Index, and Bollinger Bands, traders can refine their entries and exits. For example, if the VIX spikes while RSI on a stock shows oversold conditions, this could indicate a potential reversal as panic selling might be overextended. Similarly, when the VIX is declining and a moving average crossover occurs on your chart, it could signal the return of stability and a possible continuation of the trend. Bollinger Bands can also complement the VIX by showing whether price volatility aligns with market expectations. A wide band, combined with a high VIX, may suggest extreme market conditions where breakouts or breakdowns are more likely. Another way to use this combination is by identifying divergences. If the VIX is making higher highs, but the price of the asset is not making lower lows, it might suggest that fear is exaggerated and a reversal could be near. Conversely, a low VIX during a period when prices are consolidating tightly within Bollinger Bands could warn of an impending breakout, and traders might prepare for larger moves. Integrating the VIX with trend-following indicators like MACD, moving average convergence divergence, also adds another layer of confirmation. For instance, a rising VIX with a bearish MACD crossover strengthens the case for caution or even a short position, while a falling VIX alongside a bullish crossover could support long positions. It is important to remember that the VIX measures expected volatility, not direction, so pairing it with directional indicators helps you avoid false assumptions about market moves. Moreover, monitoring VIX levels around key technical support or resistance zones gives insight into whether those levels are likely to hold or break under pressure. A rising VIX at resistance may indicate that fear is pushing markets lower, while a declining VIX at support could suggest that confidence is returning and the level may hold. Traders who combine VIX analysis with technical tools avoid over-relying on one perspective and instead develop a multi-dimensional view of the market, which helps them navigate volatility with better timing and risk management. This approach doesn't eliminate risk, but it makes decisions more informed and less emotional, which is critical in today's fast-moving financial markets.